In this week's market update, second quarter earnings season gets into full swing. Gold and oil are in favour as global tensions rise and Britain gets a new Prime Minister. As with London buses, there's either a dearth of company news or a flood of it. This week, investors will be deluged by results announcements on both sides of the Atlantic as second quarter earnings season gets in full swing. Over the pond, the focus is on technology stocks. Most of the big names are due to report this week, including Facebook, which is in the headlines for good and bad reasons. There'll be focus on the company's recent settlement with the Federal Trade Commission over a range of consumer and privacy practices. Also in the spotlight will be Facebook's proposed cryptocurrency, Libra, which again raises more questions than it answers and has divided analysts. Also on Wednesday will be numbers from Tesla, which recently beat expectations for first quarter deliveries of its Model 3 car. Controversial Chief Executive Elon Musk says the company is on track to deliver a record number in the 3 months to June. Amazon follows on Thursday with attention focused on the one-day shopping initiative, which is enjoyed by customers but is estimated to have cost the company $800 million to deliver. Amazon has traded sideways since regulatory and antitrust scrutiny has intensified, so investors will be looking for the expected 10% or so growth in earnings year on year to be delivered. The last of the FANGs due to report this week is Google owner Alphabet, which investors are hoping will bounce back from a disappointing first quarter report. Alphabet shares are down more than 10% since those figures. Over here, there's no particular sector focus, but a steady stream of results announcements. Highlights this week include struggling online retailer ASOS, which warned on profits again last week, property giant Hammerson, which should have some insights into the flagging retail real estate market in the UK, GlaxoSmithKline and AstraZeneca on the pharma front, and Diageo and Unilever, two of the defensive consumer stocks which have led the market's charge in recent years. Although corporate earnings are the principal driver of share prices in the long run, politics can affect sentiment in the short run. And this week we'll see Westminster in focus as the Tory party leadership contest comes to a climax and Britain gets a new Prime Minister. Boris Johnson has just been announced as the winner, and everyone will be hoping that he can deliver what his predecessor Theresa May failed to, Britain's departure from the EU as mandated by 2016's referendum. He's talking a confident game, claiming that Britain will leave by the end of October with or without a deal with the EU. Whether or not he can actually deliver that promise remains to be seen. Even before the result was announced, ministers who had been vocal critics of Johnson were getting their resignations in before the new PM could sack them. Alan Duncan was the first out of the blocks on Monday morning. The Conservatives have a wafer-thin parliamentary majority, and there are still plenty of MPs determined to prevent an economically damaging hard Brexit. How they might achieve that is, however, unclear. The market reaction to the ongoing Brexit uncertainty is, as ever, being played out via the currency market. The pound has fallen in recent days to its lowest levels since the referendum, with the rate against the dollar dipping below $1.25 at one point. Domestic politics may be a little clearer this week, but the international scene is as challenging as ever, following an escalation of tensions in the Middle East after Iran seized a UK-flagged oil tanker on Friday in the Gulf. Britain's Emergency Response Committee, COBRA, met on Monday in response to the deepening crisis amid further claims from Iran that it had broken up a spy ring of 17 Iranian nationals allegedly trained by US intelligence. Rising tensions in the Persian Gulf set the scene for a 2% rise in the price of Brent crude to $63.70, and strong performances by energy stocks that benefit from a higher oil price. The energy-intensive FTSE 100 rose on the back of gains by the likes of BP, which added 1.6% on Monday. The rise in oil and gas stocks took the edge off broader market nervousness as investors look forward to interest rate decisions this week and next in Europe and the US, respectively. Expectations are high that both the ECB and Federal Reserve will cut interest rates, although bets on a 50 basis point cut in the US have now been pared back to less than a 20% chance. The smart money is instead now pointing to just a quarter-point cut, as the Fed's apparent dovishness looks at odds with economic data which no longer seems to justify easier monetary policy. If the Fed does cut rates at its meeting on the 30th and 31st of July, it will be very much a precautionary move designed to stave off a downward move in the economy rather than reacting to a deterioration that's already evident in the data. Recent jobs figures have been strong, and last week retail sales emerged much better than expected. Before next week's Fed meeting, we'll hear from the ECB's head, Mario Draghi, who's widely expected to signal a fresh round of monetary easing to combat stubbornly low inflation and slowing growth. Investors have bought bonds in anticipation of a cut in interest rates as soon as this Thursday's meeting, and a revival of the bond buying programme known as quantitative easing later this year. In the context of these central bank meetings, all eyes will be on figures from the International Monetary Fund this week, which is due to unveil an update to its April World Economic Outlook. The IMF's last report pointed to lower growth on the back of rising trade tensions, and since then there's been no real progress in trade talks between China and the US. Indeed, new tensions have erupted on a range of fronts, with the US picking fights with Mexico, India and the EU. Uncertainty and the expectation of lower interest rates in the US and, by extension, a fall in the dollar have been good news for the gold price in recent months. Last week, the price of gold hit a 6-year high as investors moved into the traditional safe haven, which is seen as a hedge against geopolitical uncertainty and also inflation. Excessive cuts in interest rates could trigger higher prices, and nervous investors are buying gold just in case. Since last autumn, gold has risen nearly 25%. Now, investors in major stock markets may be increasingly nervous about the outlook, but one new market has got off to a storming start. Shares traded on Shanghai's science and technology-focused new Star Market exchange soared by as much as 500% on the first day of trading, in what is being dubbed China's answer to America's Nasdaq market. China is hoping that creating its own tech market can encourage domestic companies to list at home rather than seeking capital overseas. That also reflects the deterioration in the relationship between China and the US, focused in particular on China's bid to take on America's technology sector leadership. The big share price rises were unusual in a country which has traditionally attempted to cap big gains in order to maintain an orderly market. The gains also came despite attempts to limit participation by retail investors who account for the lion's share of trading in Shanghai.